Hi, and welcome back to Accounting 482. This is session 11, and we're going to start setting some sales prices. So we're going to look at all the information that we've gathered so far, and now we're going to do something with it. Let's take a look at where we're at in the class. We've looked at this whole session. This is actually the last session of this module as well. We've looked at all allocating costs. We've looked at the basic terms. We've looked at calculating cost per unit, and now we're going to look at using the cost information. We're going to look at target pricing, cost plus pricing, and profit maximizing pricing. And they're just different formulas to help you come up with the correct price. But it's not all quantitative. It is also market information. And one of the most important and most difficult decisions we have to make is setting a sales price. Now, set properly, a sales price will allow a company to make as much profit as possible. But if it's set improperly, a sales will drive a company out of business. Like I talked about, all the costs have to be accounted for in the pricing of your items so that you can recoup that money to pay everybody. Not just the direct materials and the direct labor people, but everybody. So now the easiest way to set a price is to make a product or commodity that's already being sold. In this case, we can just match the competition sales price, but we all know, and I know I've got some marketers out there, that sales price is not that easy. We have competition, we'll be fighting against established competition that has brand recognition and a whole bunch of different things going on to justify a higher price or a lower price. So this is really basic, and we're just looking at the quantitative ways in this class. But I know the marketers are saying, "Hey, it's not that simple," and I understand that it's not. So to take a look at target pricing. Another easy way to set a sales price is to survey potential customers. And I know that you've probably had this type of information in other classes where you send out a survey. And surveys are very, very important and very much used today. Back in the day, they used to have a guy or a gal with a clipboard, and they would ask you questions at the mall or the grocery store, anywhere a large group of people gathered. And now they can do it on computer, and you can be targeted when you shop online. And before you sign out, they have, will you please answer some questions? Or you can get an email with the information, or you can just be approached. I know that I've filled out surveys for the marketing department, different departments in the college. So it's easier to get a hold of people through the email and through computers for surveys. So now when you get a pricing survey, they ask, they show the item and they say, what would you pay for this item? And so the average price from the survey would probably be the best sales price, because that would capture the people who, on the low end, the high end, and so you want to be in the middle. That's average is just a good quantitative point to pick. Now we call this price the target price, and we just have to make sure that we can still make an acceptable profit for that price. So we have to do the math. It's like, okay, this is what they'll pay. Can we make a profit on our product? So here's our target pricing example 1. After extensive research, Terry Company has determined that they can charge $50 each for their new line of backpacks. So I'm going to bring up our overhead. I like that. Okay, for session 11, and I haven't started anything. So we're going to do our target pricing. Target price is $50. Oh, not a percent, $50. And our desired markup is 15%. 15%. Desired, guess I should, there we go. is 15%. So our target price equals target cost plus our target cost, that's target cost, multiplied by the markup percent. Okay? This is your equation. So our target price was $50 and our target cost plus our target cost multiplied by the 0.15, which is also 15%. So our target price is equal to, and this is just basic algebra, 1.15 target cost, sorry. So now doing some more algebra, basic algebra, total cost is equal to 50. I'm going to try to do this correctly with my little underline. You know how these work for me. Okay. 1.15. And we're going to get a target price. I need to take my lines, my extra spaces out of here too. Okay, so when you do the math, you're going to get $43.50 as your target price. I am going to, no, this one here. And we're going to do that. And I'm going to take my extra spaces out so that it's a little easier to see. Okay. So here's our target cost. We're going to bold that. Okay. And now these are your direct costs only for this. Now we're going to jump back to the PowerPoint. Terry wants to earn a 15% profit on the backpacks, so that's where I got that. I kind of jumped the gun. Now, the current production plan calls for $15 worth of materials. We're going to see if we can make it for this $43.50. The current production plan calls for $15 worth of materials, $12 worth of direct labor, and $8 of variable overhead. In addition, the company will expect each backpack to cover $4 of direct fixed costs and $7 of general or indirect fixed costs, should Terry make and sell the backpacks. Now, we want to look at direct costs only because the general indirect fixed costs, they have to pay those anyway. So we're not going to include those in our calculations. So I'm going to pull up our overhead. I know that. Is that annoying, you guys? Are you thinking, stop doing that? I'll stop. Okay, direct cost. I'll still call it that. I just won't do the quotes. Okay, so we have direct materials. And those were, tab over, $15. And direct labor is $12. And our direct fixed costs, I didn't go far enough. Let's do one more tab. Is $4. And our variable overhead is $8. Now, if this total is less than the $43.50, it's safe to make these. Okay. So our total here is $39. So, yes, we can make them and make our money. Okay. Now back to the PowerPoint. So, should Terry make and sell them? Yes. This is a little more straightforward than the last couple of sessions, but I liked the big example we did last time. I really enjoyed that. Okay, so the cost plus pricing is an alternative method for setting sales prices is to set the price that is best for the company. And that is taking all of your costs, adding a percentage to it, and having your item sell at that price. Now we estimate what it costs us to produce the product and add on the profit we want to make to get the price. But this ignores the fact that customers they don't have to buy our product, especially at the price. This might be considered your manufacturing, your MSRP, manufacturing retail price, MS, manufacturing suggested retail price is what that is. And this is how they come up with something like this. So now the steps to cost plus pricing. We want to estimate the number of units sold in the first period. And then we want to compute the per unit production cost for the estimated sales level. And we want to calculate the markup percent using the following formula. Required return on investment multiplied by the investment plus the S&A expenses divided by the unit sales multiplied by the unit production cost. And then we multiply the per unit production cost by the markup percentage. And finally, we add the unit production cost and markup to get the sales price. So we're going to do this. You want to keep this list handy. I've got it set up on my separate computer so I can take a look at it. And we're going to work on this formula on this next example. So Terry has determined that there's a demand for a student market for a new leather backpack. Their research suggests the following demand for the new bag. And you've probably seen this type of probability problem in your business math you probably use this in your engineering or anything like that. So 10,000 units, the probability is 25%, 15,000. The probability is 40%, and 25,000, the probability is 35%. So we're going to want to do the math on our overhead. No quotes this time. I won't drive you crazy with that. Okay. So this is cost plus. Do I have that other target pricing? Yeah. And cost plus. And I will bold this so that you know where the next example starts. So we have step 1. We do not want that bolded. Step 1. We need to estimate the number of units we will sell. So we have units, and this is just the chart from, I'll leave a little room. Yeah, this is going to end up on a couple of pages anyway, so we'll be okay. Multiplied by the probability, and this is going to equal our weighted average. So we have 10,000 units, and our probability is 25%. So our weighted average is 2,500. And 15,000 at 40% is 6,000. And 25,000, 5. At 35%, Gives us a weighted average of 8,750. And now we want to add these up to get the units that we think that we will sell. And that is 17,250. We'll bold that because we will need to take that number going forward. Okay, now step 2. I should just leave it bold. Okay, step 2. I'm running out of room. I'm going to go on to the next page. That will give us a little more room. Okay, step 2 is the production cost per unit. And we're just looking at the production cost. We're not looking at the period costs because we will incorporate those in later. So the production cost, and we're going to do these formulas out so that you can see them again. Direct materials plus direct labor plus manufacturing overhead. And we've learned this going on, this is what we've talked about for a while. So let's go back to the PowerPoint. Each new backpack will require the following: $12 of direct materials, $25 of direct labor, $6 of variable overhead, and $1 of variable S&A, mostly commissions to the sales force. In addition, the new project will be assigned $45,000 in fixed manufacturing overhead, $70,000 in fixed S&A expenses. Oops. And the new project will require a $500,000 investment by the company. Now, Terry's hurdle rate is 15%. Hurdle rate is the return on investment. All of these mean the same thing. Hurdle rate, return on investment, payback amount, any of those is the amount that you want to make above and beyond your investment. So, using that information, we can continue. We have $12 for the direct materials. Try to line this up, see if I can do it. That's better. And $25 for our direct labor. And our manufacturing overhead has 2 components. We've got the $6. And then we have the fixed. This is a variable, and now we have the fixed. I'm going to drop down right here. And I'm going to compute the fixed overhead. And we've got, back to the PowerPoint, we have $45,000 in fixed manufacturing overhead. Okay, and we want to make sure, yeah, that's fine. We want to make sure that we divide those equally between the items that we're going to sell. So we've got the 45,000, and we're going to divide it by the 17,250. And we're going to get a fixed overhead rate per unit of $2.61. So our manufacturing overhead is $6 for the variable plus the $2.61. So that's going to give us a production cost of $45.61. And we're going to bold that because we'll need that going forward. And I'm going to move this up so that we don't waste space. Okay. So now you know how we got that number. So now we're going to go on to step 3. Step 3. And this is the actual equation, which is the desired markup percentage for that equation. So we've got the required return on investment multiplied by the initial investment. Of course, this should have a parenthesis around it, plus my S&A costs we're going to divide that by the production cost per unit multiplied by the number of units. So our required return on investment is 15%. And our initial investment is $500,000. Plus our S&A costs. And now we need to come down here and figure out our S&A costs. And that's our fixed costs plus our variable costs per unit multiplied by the number of units. So these are actually called the period cost. And we have, from our PowerPoint, $70,000 in fixed S&A expenses. So we have 70,000. I should do it this way. I think this will be a little easier to understand. I keep thinking of how it'd be easiest for you to look at this again when after you've watched the video. And I'm just trying to make it organized so that you can see it. And then we want to add that to our variable cost per unit, which back on the PowerPoint says $1 of variable S&A. $1 multiplied by the number of units, which again is the 17,250. And that's going to give us S&A of 87,250. Okay. So we can put our 87,250 up there. And we want to divide that. Oh, let's get some line there. Okay. We want to divide that by the production cost, which is our 4561. Multiplied by our units produced, 17,250. And that's going to give us a total of 75,000 plus 87,250. No line. Divided by 786,772. is about, I don't know if I have a little about. I do not have a little about. So it's about 0.2, no line. Look here, pal. Really don't want the line. Or 20%. So that's our market percent. So I'm going to bold that. There's our market percent. And now I am going to get another page for step 4 and 5. Step 4 is the markup in dollars. The markup in dollars. So you've got your production. Oh, I'll move this up so you can see it. Production cost per unit multiplied by the percentage. Okay, I know this it's probably, see where this is going, right? 45.61 multiplied by 0.2 is going to give us $9.12 approximately. And then step 5, we're going to get the sales price. And now this P, capital P with an underline, is an accountant's way, or cost accountant's way of showing you the price. So if you see P, capital P with an underline, and then a number, you know that's the price that they're recommending. Or you can do that when you are doing this in your business or for your boss. So the production cost is $45.61, and we're going to add the $9.12 because that's our markup. And we're going to get a price of $54.73. So here's the price that they recommend that we price our product up with cost plus. Okay. So there are some drawbacks of cost plus. You can only get your ROI if you sell the numbers that you've estimated. And if you sell fewer items, then your ROI will be lower. And if you sell more units, if you've decided to, you can only sell more units if you make more units, right? And then your ROI will be higher. But if you've only decided that you're going to sell 17,250 and you only make that many, you're not going to be able to sell them because you don't have them. And now you don't want to try to force your prices on the market because that may have long-term consequences. So I don't know if many of you shop at JCPenney. I have shopped at JCPenney for years, and they have had pretty aggressive marketing. They started a price, and then they put something on sale, and then they give you this $10 off coupon. So you go and you buy the sale item, and then you have $10 off, and they used that product, and then this to set an ad in retail. And I've done this. You get the ad package from corporate, and it has your list of items on sale. It has your signs, so you have to take down the old ad, all the signs, all the ads, and the where I worked, you had this, prominent areas in the store, like right by the doors. We called that front and center, and every week we would put the items that were like the nice expensive items that were on sale. That's where we would put them front and center. And so you'd have to tear those down and build the new ones for the week. And it took a lot of time, a lot of manpower to set these ads. So Penny's got a new CEO, and he decided to cut costs. He would eliminate that ad setting process, and that they would mark down all their goods to the price that they normally went on sale for. So people didn't have to wait for the sale. They could buy it at any time for the sale price, and They didn't have to worry about any of that. Well, what happened was the customers stopped shopping there because and all the marketers will tell you this, there's a there's a thing about shopping and hunting for the best deal and uh, looking at all the items and trying to find the best price. That is an American, what term am I trying to think of? It's just the way we shop in America. So by eliminating all of that, the hunt for the deal, it just really turned the customers off, and they lost a lot of sales. Their merchandise didn't change. The only thing they changed was that pricing, and customers didn't like it. And they spent a lot of time reticketing everything to the sales price. I had friends that worked there, and they said, "Oh, we're remarking everything," and they actually closed down to remark everything to the sale price, and then they came back and opened up, and then they realized their sales were down so much they had to close the store again and mark everything back up, and then run the ads again because the customers were not used to that type of sale. And yeah, so you can't force your prices on the market. You have to let the market decide what it's going to pay. Oops, there we go. Whew. Don't want that to completely go away. All right. So profit maximizing price is a different method. And this final method is setting sales prices is based on economic theory. Now we calculate the price that will give the company the best trade-off between the number of units sold and the profit per unit. In this case, in using this method, the company must have some information about the way price changes affect the demand for the product. And we're talking about elastic and inelastic prices. So, the steps to profit maximizing price: first, you must determine the percent change in sales price and the resulting percent change in the quantity sold. The second step is to calculate the elasticity of demand using the following formula: logarithm multiplied by 1 plus the percent change in quantity sold divided by logarithm multiplied by 1 plus the percent change in the price. And then once you get that number, you will calculate the profit maximizing price using the following formula: the elasticity of demand divided by 1 plus the elasticity of demand multiplied by the variable cost per unit. And that sounds like it's really hard, but it's not too bad. Now we've got the example here for profit maximizing. And so Terry introduced his new leather bag at $55 each. The demand for the first period was 45,000 units. In the second period, Terry raised the price to $60 and the demand dropped to 35,000 units. Using this information, what is the profit maximizing sales price for Terry's new bag? So let's go back to our overhead, and I don't know if I have enough room or not. I think I'll be okay. So this is profit maximizing, and I'm going to leave that. Leave it bold so you can find it. Okay. Now, profit maximizing price, and this is step 1. We need the, I don't have the symbol that I need. I'll have to type it out. Okay, the percent change. I wanted the little triangle. I don't have one of those on my screen. I imagine I could probably go into the different fonts and find one, but we'll just do this. I think it'll be faster for me. Okay, percent change for quantity plus the percent change in price. So I should underline that. So the new, no underline. Oh, I wish that would just go off. You'd think I'd remember. Okay. The new price is $60. Whoops. $60. And we want to subtract that. I'm going to tab that over. Minus the old price. I'm going to have to get rid of that because it's driving me nuts. Is $55. We're just going to underline all of it because we're going to have is the change in price the change in price is $5. Okay. And I'm going to pop that back there. Okay. Now the change in price divided by the original price. So I really don't like that. I'm just going to drop them down because it makes me crazy. It still gave me I need it though. 55. Oh, I knew I would do that. Is 9%. So we've got 9%, and now we need the new quantity subtracted by the original quantity. And those are, oops, not that far, 35,000. And 45,000. Oh, there's no line here. There's a line there. And it's 10,000. So our change in quantity divided by our original quantity is negative 10,000. Divided by 45,000. It's going to give us a negative 22%. Where did it go? Way over there. So negative 22%. Now these are the numbers that we're going to need. The 9% and the negative 22%. Those are the numbers we're going to need in the next step. Okay. So now step 2, and I can't do my next symbol with what is the elasticity of demand. So we're going to do E and then a little d. Elasticity of demand is actually a round E and then a little d, but I don't have that option. I'm sure I could figure it out somehow. So now we have logarithm. It's not supposed to do that. We'll just go like that. Oops, wrong way. Logarithm 1 plus the percent change or percent quantity divided by logarithm. And this is not as bad as it seems. It really isn't as bad as it seems. In a calculator, it's really quite easy because the calculator, I could probably do it on my calculator on here, but this isn't too bad. Oops. Equals logarithm 1 plus, and this is the numbers that we're going to use, the negative 22%. Okay. Logarithm 1 plus 0.09, and that is going to give us negative 0.2485, and that's what you can do in your calculator. It's pretty simple. And 0.0862. Okay. And this equation is going to give you a total of negative 2.888. We're going to use that. Oh, that would be step 2. And that's going to take us to step 3. And this is the profit maximizing price. And I can't do the big parentheses, so I'm just going to have to do elasticity of demand divided by 1 plus the elasticity of demand multiplied by variable cost per unit. We're going to throw some numbers in here. So our 2.888 is going to be divided by a negative 1.8881 minus the elasticity of demand, multiplied by 44. Now, how do I get 44? Let's go back to the PowerPoint. And we're going to jump up to, this is our Terry. We're going to have the $12, the $25, the $6, and the $1. Those are variable costs, and that is how we got our 44. And I will put over here 20. I'm going to run out of room. 44. I will just, we'll just put variable costs from the slide. And that will, I can move that over a little bit. I knew I was going to run out of room. And so that's going to give us our cost. When you do that math, you're going to get $67.30. This is your profit maximizing price, which is higher than what you were selling them for to begin with. But that's going to tell you what the price should be. So going back to the PowerPoint, and okay, so this is the JSM that we talked about in the last session. Now in session 8, it's actually session 10. Oh, yeah. Session 10. In session 10, we calculated the total production and full cost of JSM's 2 product lines. Using the information from those calculations, calculate JSM's cost plus price. JSM's desired ROI, return on investment, is 15%. Now, the company's initial investment in the stone line was $400,000, and the initial investment in the bronze line was $750,000. So, I have brought up the sheet from yesterday, and we're going to be using, let's see here, can I insert a shape? We are going to use no, we want it transparent. Okay. Oh, that just did not work, it did it. Okay. Take that off. Okay. This is the total allocated cost for S&A for the stone and the bronze. These are the what we sold, and the cost, the total cost, not the full cost, the total cost is going to be on this last page also, I believe. Yes, the total costs are right here, 104.40 and the 104. And I wish I could just, oh, I know what I can do. I can highlight that. Oh, that was so simple. Too simple. Too simple. These are the numbers that we're going to be using in this assignment to find the cost plus. So I'm going to go back to, I'm going to take that off. And this is cost plus cost plus. I've got my dog out there growling at the door because they don't like the door closed. So if you hear something, it's my dog. Okay. So for JSM Inc., should be one of those. Okay. Step 1. I don't think my husband knows that it's he's out there. The number of units we will sell. That up so everybody can see it. Now he's barking. Okay. Bronze, 12,100. And the unit production cost. Stone is 104. And this is what I highlighted from the document we did yesterday in session 10. Now you know how I'm working. Okay, so I'm going to break away and do another full page because we're going to need it. Okay, and this is our step 3. And it's our required ROI. Multiplied by the initial investment plus S&A. Okay. Divided by the estimated number of units sold. Whoop, no line. Estimated number of units sold. Units multiplied by the production cost per unit. So now we have, I'm going to put an equal sign. And so now we have 15% multiplied by 400,000 plus the $325,424, and this is for the stone. Okay, step 3, stone only. Okay. And the units that we sold, the estimated units, okay. We'll carry a little silly line. Okay, 9,900 multiplied by the unit cost, which is $104.40. Once you do the math here, you get 60,000 plus 325,424, comma 424. Oh, that silly line. 1,033,560, and you get 37.3% markup, which is not too bad. So step 4, well, step 4 Okay, I'm back. I had to go get the dog. He was growling and barking. Oh my gosh. Okay, so step 4, we want to take the price of $104.40 and we want to multiply it by the 37.3% to get your markup dollars, your markup amount. And we get $38.93. And then step 5 is our $104.40 plus our $38.93 gives us a total of dollars, $143.33. So here's our price that we should charge if we want to get 15% return on investment on the stone statues. Now, if you want to do all of the math for the bronze, the total cost for that one will be $179.67 if you do all the math. We're not going to do that here because I've run you out of time already. These are long. They shouldn't be as long, but okay, so but this does not include the well, it does include the S&A right there. So it's all included. This is the price that you should pay or charge to get a return on your investment of 15%. So back to the PowerPoints. So why is setting an appropriate price so important? You need to have an appropriate price because it has important ramifications for every company. Too high and you lose customers, too low and you lose profit. And it's also an iterative process. Once you get the price set, you can't just leave it there and call it good. You have to monitor those costs of the direct materials. You have to monitor the cost of the direct labor. You have to make sure your overhead costs are still the same. And then you have to make sure that the market is still purchasing your item at that price. Have the prices gone up? Because sometimes all the price of the direct materials and such go up, and then the whole industry raises prices. On the other hand, if you've got technology that is older and new technology is coming out, then your prices are going to decrease, and you need to watch that. So just setting a price the first time is it's not like you're done. You have to keep looking at your prices, and it's something that we have to monitor all the time. So this is the end of session 11 and the end of the module. So your first exam will be on the modules 1 through 11, and we will have that exam coming up. I don't want to give a date because I plan on using these for other classes, but we will start next week into the budgeting module, and that is a lot of fun. So we'll see you then. Thank you.